Well guys, this is the biggest week for my portfolio personally, with Amazon reporting earnings this week, and we have Apple reporting this week, which by far and away is the largest position in my portfolio by a mile. So how do you handle a situation like this where more than 50% of your portfolio is made up of just one stock? And where do I see earnings going for Amazon and Apple? And we'll talk about a bunch of other earnings too. Right after you gently tap that like button and consider subscribing too. It's super easy to do if you like the truth without the hype. So let's start off talking about some of the earnings over the past few weeks that are personally large positions in my portfolio, so that way you guys kind of have an idea as to what I was thinking, what I thought when I saw them, where I see them going here in the future, and all that good stuff. So we'll kind of start off first with Google. And with Google, you saw both a beat on the top and the bottom line. All the ChatGPT noise that we were having to hear and having to deal with hasn't come true, guys. I mean, it didn't really kill anything. Neither did the whole advertising apocalypse that was supposed to happen this year, and all the other narratives that were around Google when you could have bought it under $100 for several months in a row. It was just an incredible opportunity for an incredible business. And I don't know where these narratives come from, where companies are dead and something like ChatGPT that is still in the very infant stages of what it may be able to do in the future, much less be monetized and actually take away business from a company like Google. I don't know. That's just where the narrative was. And obviously, it hasn't played out because these earnings were absolutely great. And you saw things like advertising actually going up, actually increasing them, actually saying and reiterating that, hey, we don't see a slowdown in advertising that other people are seeing. They're even seeing an increase in advertising on YouTube, which of course is good for us as creators here on YouTube if they choose to actually, share that revenue with us. I don't personally get a lot per video. Some other guys get a lot more. It's a whole different video on how that works and all that good stuff, and it's really irrelevant here. The point being, they're seeing even ad revenue on YouTube continue to grow and continue to increase, which is the exact opposite of what the narrative is. And it's why right here on this channel, we completely ignore the narrative. We look at the fundamentals of the business, the fundamentals of what's going on actually in the economy, not what everybody's saying is going to happen or what this economist says or whatever all the noise is out there. We completely ignore all that, and we just look at fundamentals of a business and, obviously kind of, I hate to say use our brains, but I don't know what other word there. We use our brains to kind of go through, wait, this company's growing. This company absolutely has a moat that's not going away anytime soon. So why the heck wouldn't I buy this stock when it's on a significant discount from a valuation perspective? The bottom line with Google is they continue to perform like a top 5 company, which is exactly what they are. And speaking of another company that was just kind of beaten into oblivion that nobody wanted any part of, that would be Facebook or Meta or whatever the heck you want to call it. But once again, what was the deal with Meta? What was the coming narrative with Meta? Their earnings were incredible. Once again, growing everywhere, seeing virtually every business line get better all the way around. But just a few months ago, we were supposed to stay completely away from Meta. I mean, ignore the fact that they're printing money despite earning, billions of dollars on the metaverse. Ignore the 3+ billion with a B user base that Meta has at their disposal. Ignore the fact that it was trading at a PE of like 8 when stocks like Coca-Cola were trading at a PE of like 30+. And a lot of other stocks like that have, virtually no growth, they're very low growth, were growing and had PEs at ratios that were just, 30, 40, 50. And here's Meta over here at 8, but I'm supposed to not buy that stock, which actually has growth potential, in exchange for buying these other stocks over here that are extremely overvalued. So they just wanted you to just ignore valuation altogether. Forget or just completely ignore the fact that they're not even monetizing things like Instagram fully, WhatsApp hardly at all. They're not monetizing a lot of their platform that they have out there to actually be monetized and to print even more cash. Not that they need to print any more cash, but the fact is, those are more revenue streams, more business lines, and highly profitable business lines that are just sitting out there waiting to be tapped into. But we were just supposed to ignore all of that and just sell it because it's just a dead company. It's going nowhere. It's not even going to be around in a few years because, they're just chasing the metaverse and it's a fad and everything else. Despite the fact the numbers said, yeah, they were burning cash on that. However, they were still printing cash on the other side. And when he finally got his head up out of the metaverse for 5 seconds and decided, hey, I need to cut all these employees. We hired, possibly thousands of employees that literally were doing nothing at the company at very high salaries. And all of a sudden, magically, all the numbers instantly turn around, instantly look great. instantly basically make Meta look like a juggernaut again. And now everybody's on board on this incredible turnaround that wasn't really a turnaround. He just had to pay more attention to his business a little bit. So we gladly continue to buy this one as Wall Street just got stupider and stupider and stupider. And the reason why is for earnings like right now. It was right there in the numbers, 6 months ago that this was absolutely possible. And here we are, and valuation told me, buy, buy, buy. There's no reason not to continue to buy at that stage when it's that beaten down. And here we are just a few months later, and now we're having incredible solid earnings. And you're basically sitting on a 4x right now on this stock. So we've made a ton of money on this one, but we got to talk about Tesla's earnings. And unfortunately, it wasn't as good as Google's or Meta's. But that doesn't mean that I'm necessarily down on Tesla or anything else like that as well. Now, if you want full details on all that, click the video right up here. It'll give you all the full details on my thoughts on Tesla's earnings and also the Tesla bulls, if you're into that thing. But nonetheless, when I sat down and I looked at Tesla's earnings, I knew before it ever came out, they are going to have short-term pain for long-term gain. That's the strategy Elon's using right now to grow the business, grow market share, grow a lot of things, while also, unfortunately, taking a hit to that bottom line. And that's exactly what we saw with Tesla. Now, it doesn't mean I thought the earnings were bad or terrible or anything else, but it's absolutely Wall Street's game, and Wall Street wants to play a short-term game. In short term, I can't say that the earnings were great. I can't say that they were incredible, and I can't say that even the next quarter setup is great and incredible either. Now, that doesn't mean it can't do great and incredible things, but based upon the earnings call, they basically set us up for a rough next quarter before finally getting back on track there in the fourth quarter. And in Wall Street's eyes, that means trade it down in the short term, and that's exactly what's happened so far. So again, I'm not saying it was terrible, worst ever, or anything like that, or I have any concerns. I don't. But I also understand why that earnings was not like Google's or Meta's earnings, and I can't accept it that way either. And of course, now my portfolio is taking a hit because Tesla has traded down. But again, hey, let Wall Street get stupid. I'll happily start buying that stock again too. But on to the massive week that will absolutely shape my portfolio far more than the past few weeks had. And I'll tell you exactly what to do when a position gets so big in your portfolio, like it makes up more than half your portfolio or more. I mean, should you take profits? Should you rebalance your portfolio altogether? I mean, how exactly do I handle this situation? So we'll walk through all that step by step too. But first, we got to discuss Amazon's earnings, which I think are honestly going to be kind of so-so. I mean, it's not nearly at a level where like it was last year, where it was so stupidly cheap from a valuation perspective, and it was just beaten into oblivion, under 100. I think we got down in the 80s or so. But I don't like it in terms of price and valuation right now as it has, or like it was last year. And that's simply because they haven't really performed on earnings. They've had some stumbles, not terrible, not anything I'm concerned with long term, but short term, they've had some stumbles on their earnings. And unfortunately, it's had a nice run since it kind of had that bottom there in the 80s. So, from a valuation perspective, it's not something that's interested me. And I think we still have some bumpy earnings to go to kind of get rid of all the post-illness, overexpansion that they did, cleaning up a lot of that. They also have a lot of new business lines kind of getting started, getting running. I won't say it's a business in transition, but there's definitely some transitioning going on as they kind of, maybe repositioning is the better word, as they kind of reposition the company. So I don't expect blow it out of the water, stellar earnings, kind of like we saw from Google or from Meta. However, I don't suspect I'm going to see anything that's going to be concerning either, which for me, it's a great setup as a long-term buy and hold investor because it means Wall Street may not see that they're going to 10x, in the next quarter. So they may actually trade it down, just kind of like they're doing with Tesla right now. And if it gets down to a juicy enough price, I will absolutely be adding to Amazon stock. So that's kind of where I kind of say, I expect to see mixed earnings. I expect to see you be able to make a very good bull case, a very good bear case as well for that stock. And in the end, I hope Wall Street just decides there's better opportunities out there and they beat this stock down so I can add more. And on to Apple, where I quit guessing their earnings more than a decade ago. I mean, it seems like there's just no way they can continue to grow, and then they continue to grow. There's no way they can continue to increase this pace or continue to increase their EPS at this rate, and then they turn right around and do it anyways, over and over and over again. And then when that train eventually stops, because it has to stop, you just can't continue to have blowout earnings after blowout earnings forever, then everybody kind of writes off Apple, and it kind of goes in the exact opposite cycle where you get, a couple quarters, sometimes even a year plus, to buy Apple on a huge discount because, Wall Street's saying it's a dead company. Where's the growth going to come from? What's going to happen here? Nobody's going to buy any of the new iPhone, which they say that every year. But nonetheless, those narratives persist and keep it beaten down. And then all of a sudden, out of nowhere, it goes from kind of being on the decline and, hey, it was at the top of the heap, but then it's going down to right back to the top, and it's the best run company in the world. And it's just a beast all the way around where everybody in the market runs to for safety. and growth at the same time, kind of that safe growth if you want to call it that. So to me, trying to sit back and trying to guess what's going to happen with Apple each stage, to me, it should have already had its kind of fall per se. It should have had earnings that weren't just great. I mean, after all the shutdown, lockdown, that growth and that incredible growth, and you're like, okay, this can't continue. Sure, when everybody's getting $5,000 stimulus checks, you can afford a MacBook, but who the heck, and the $1,500 phone and all the rest. But once that dried up, who's going to keep buying that stuff? How does that stuff continue to grow? Who continues to buy these things? And I don't know. I don't know the answer specifically. I just know that it comes through in Apple's earnings over and over and over again. So to me, I don't know how they continue this pace. It's absolutely overvalued in my opinion, of course, but trying to bet against that or trying to figure out when it's going to have its fall, or is it just going to kind of stagnate for a year and then, so that way the valuation kind of catch up to it and then move next. It's almost impossible to guess at this stage what's going to happen with Apple. But there's no doubt in my mind, I suspect that if we have that situation to where it finally, I won't say has a fall, but it finally has an earnings to where it's just kind of like, hey, yeah, we're going to be, growth isn't quite what it was. And we suspect, over the next couple of quarters, growth is not going to continue to see what like we saw in previous years. That could absolutely send the stock down, which of course is going to devastate my portfolio in a sense in the short term because it makes up such a large part of my portfolio. So let's talk about exactly how you handle that situation, at least in my opinion, so that way when you have a stock that is making up a disproportionate amount of your portfolio, you'll kind of know at least my thoughts on exactly where to take that, exactly what to do. Now, if your strategy just is all in on one stock, hey, more power to you. I understand that's a strategy that's out there, especially here on YouTube. Not one I personally partake in, but understand I'm not necessarily discussing those folks. I'm discussing somebody who bought a stock like an Apple for me, and it just grew into the largest position long term. So for me, I do not have more money into Apple, and I didn't put half of my money into Apple, and that's the reason why it's half my portfolio. I've actually put more money into other stocks like Meta, like a Google, like stocks like that, than I've actually put into Apple. However, because I've owned Apple for so long and it's grown so massively and had such an incredible run over really almost 20 years now of owning the stock, that's the reason why it makes up a disproportionate amount of my portfolio. Not because I necessarily put more money into that stock than any other stock. Nothing could actually be further from the truth in regards to that. So, what do you do? Well, how do you handle that situation? The bottom line is, I don't punish winners. To me, there's no point in rebalancing. That's a fun thing that they have to do because they can only own a certain percentage of a certain stock, or some other rule like that they have, or they need to show profits so that way they can show investors they have profits, something like that. I don't have to do any of that. My portfolio wouldn't be nearly as large as it is right now if I rebalanced every time that Apple went on some sort of a run of some sort. So I would basically, honestly, be missing like 7 figures in my portfolio if I'd done that, because you're trying to tell me I somehow could have traded that money in and out and made it grow better than Apple grew during that time. I'm punishing a winner there. You guys got to remember that when a great stock goes on a run, and it's rare, and I'm not talking about 2020, 2021 10x stuff. I'm talking a true great company goes on a 10x run. If you cut that stock, great companies tend to not just go on one, they tend to go on multiple 10x runs that you can't predict. Nobody knows when they're going to happen. Nobody knows what's going on whenever they actually are going to do it. But the point being, that stock is going to reward you many, many times over the long run. And if you choose to sell, to rebalance, and then try to guess another stock that's going to get you that same exact return that that great company is already getting you, that to me is just fool's gold. You're trying to trade, and I don't know too many traders that win long-term over the course of 2 decades as well. As a matter of fact, I don't think anybody has done as well as Apple did over the course of that 2-decade run. There's not, I'm sure there's a stock out there that has beaten that return over the course of that 2 decades. I'm sure. I don't know what it is. Maybe there isn't. Maybe Apple is the one. The point being, I would have never known because I would have been rebalancing the whole time and still looking at a very nice return on my portfolio. However, there's no way it would be nearly as large. So the way that I kind of view it, the way that I kind of frame it in my mind is, would you rather have a portfolio where one stock makes up, more than 50% of the amount in your account, not because you put 50% of your money into that stock, but because maybe you put 10%, 5% of the money into that stock, and it grew into 50% of, your position there. So basically your account is double the size that it should be because you let the winner run. Or would you rather have rebalanced that portfolio, have that position be, 25% of your portfolio or so, but you also have a portfolio that's half the size it would have been if you would have just held on to that stock and not rebalanced each time? Great companies always crush diverse portfolios, or you might as well just buy the S&P 500 at that stage if that's really what you're trying to do. Now, I'm not advocating go all in on one stock or anything crazy like that. You guys know that I don't do that either. However, I'm not going to take profits either because a great stock that's going on some sort of an incredible run, where do you cut the run? I mean, do you cut it at a 2x? Do you cut it at a 4x? And a great company, like I said, that 10x's probably has another huge move coming. Maybe not a 10x move, maybe a 5x move, maybe a 2x move. Nobody knows, but I mean, I didn't know I'd get almost a 2x move in Apple, basically from, the pandemic forward. I had no idea, but that's exactly what you got out of the company that was already kind of basically tapped out. It was already the biggest company in the world. How much further can it go? And it just continued to march further and larger up. Remember, a great company not only has one 10x, they usually have multiple 10x's, but unfortunately, and the reason why I don't cut a stock that's a winner like that is most companies never even have one. They never even have one 10x, much less multiple. So when you have a stock that's a proven winner, not in a hype market, not in some crazy trash penny stock, craze, whatever, but an actual great company over the long term that's producing like that, there's no reason to me to try to cut that, to try to find something else that could perform just as well. Now, I may not put new money into it, but I'm absolutely not going to cut it either in the name of rebalancing or all those other things like that. I don't punish winners because I just end up punishing myself in the end. And if you want to see me execute this strategy in real time, see all my buy and sell alerts in real time, see my watch list with price targets, be able to take 5 courses for free, get that stock analyzer tool completely free if you're a member, and a ton of other information. I mean, heck, you can slide into my DMs. You can jump on our Q&As, ask me questions live. I stay on there as long as you guys have questions, and a ton more. Make sure you check out the pinned comment down there and see if a membership's right for you. And click this video here to see the exact stocks I'm buying right now, and click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.